If you look at the sources of financing, you also have to look at formal equity. And formal equity is complementing informal equity in the equity market. It's still all early stages, it's not the later stages. And you can differentiate formal equity into venture capital on the one hand and strategic investors on the other hand. And the difference basically is financial venture capitalists are purely financial investors, and strategic investors also have strategic goals, which might play a role in their behavior. First of all, let's look at an example, and there you can see why it's important, if you look at all the sources of financing together, also to look at that. When we look at Facebook's financing round, as we said, Facebook started in 2004 and has been financed by Peter Thiel. It says $500,000, 400 or 500. We had, I think, different sources for that. But then the following rounds were also being done by angel investors, again, like Peter Thiel, for example, or the Zamba brothers. They are also angel investors, but also venture capital that came into play, like Excel Partners and Greylock Partners. Another angel, Reid Hoffman and Ron Conway, came in. So you see, it's a mixture, first of all, of early stage angel investment, then going over to venture capital investment. And then you see Microsoft invest an unheard of $240 million US dollar into Facebook, which is a strategic investor, purely a strategic investor. And then Facebook is going public, and if you would like to differentiate equity into private and public, you see they went to the other side and they offered their shares actually to everyone, to the public. They did this initial public offering. I mean, this is a very popular example. But there are many companies who do something like that. Not every company's gone public, but many companies who first have angel investors. I'm always talking about my companies, but we often start with angel investors. And then if we have the bigger rounds, we go on to venture capital. And then we might go with a strategic investor or sell or merge or do something else. And I think the art of the startup CFO is put them in line properly in the way they are needed for your company and in the way they can add the most value. And this is something you have to learn in terms of understanding the capitalists, their limitations, their additional help and so on, in order to really know when to take up which kind of money. First of all, it's just a technicality of differentiating those. So angels, they are the ones who have less money. Venture capitalists might provide more. And you can see that over here also, venture capitalists are more formalized in the way they act with you. And the reason is their formal organization, and I'd like to comment on this a little more. But since they have own investors, it's important for them to also have control, information rights, because they have to report to their investors themselves. If an angel invests into your company, actually, if I invest, I don't care too much about formalized information rights because I'm going to call the entrepreneur and ask about it, and they always talk to me. So this is working out fine. But venture capitalists, they have to report to their investors on a quarterly basis. So they need the information of their portfolio companies a couple of weeks before to put together their own reports. And this is why it gets more formalized if you go from there to there. Let's look at that in a different chapter. So if you ask Ben Horowitz, and he was a founder of a great company and later on got angel investor / venture capitalist, he's saying, okay, angel, what's the value of an angel? Well, connect using his own money, own low capital, but he understands the nature and idea of building an entrepreneurial company. And they are a lot closer to the entrepreneurs. I mean, you can comment on some of the people here if this is really the case, it's like the entrepreneurial endeavor, or if they can add something else. And we should look into angels more closely to understand that. If you look at venture capitalists and compare it, they do have a different approach. They can also give you hand-on service, but by experts. They take in experts for specific fields, and this is how they help you, but they also need like board seat, information rights, and so on. I said that before, because they have to manage the capital of their own investors. Venture capital investments are still getting popular. You see the numbers rising here. Not really in 2016, but you see the number of deals closed and also the amount invested in billions of US dollars. It's going on 2017. So venture capital also shows a positive direction. I mean, we said that with crowdfunding before, we can see it with business angels, we can see it with venture capitalists. I mean, the markets are getting hotter right now since there's enough capital and not so many investment opportunities. But venture capital is a good investment opportunity. However, if you're an investor into venture capital, you also have to strongly differentiate the good ones and the ones who don't perform too well. If you're an entrepreneur, the most important thing is, and having seen all the potential investors so far, to understand these investors more closely in order to be able to play with their specific role, to integrate their specific role into the development of your business.